What if everything you thought and believed about successful buying, selling, and financing your home was wrong? Welcome to HomeWise with Michael Midget. This is where you can count on straightforward, objective advice on the right way to make the most out of every dollar you put into your home. Whether it's buying, selling, or financing, even maintaining and growing its value along the way. Coming to you from the NewsTalkSTL studios at Union Station in St. Louis.
Welcome to HomeWise. If this is your first time joining us, welcome aboard. We're glad you're here. I'm Stal Ponticus, the creator and host of HomeWise, Michael Midget. Michael, good to see you, buddy.
Hey, good, Stal. How are you?
Doing fine, thanks. What do you got?
How was your week?
Oh, it was pretty good. Pretty good, thanks.
Anything interesting happen?
Well, you know what? On a realty note, this is just something I'm tossing out there. Where we live out in Washington, there's an empty lot next to us.
Okay.
That's on our block. We're right across from a park.
Sorry about that.
No,
the park part's good. But,
we have a really nice location for our home, but there happens to be an empty lot between us and the folks next door. And so my wife was thinking maybe we should pursue trying to purchase that empty lot. It's got a ton of trees on there, and nothing's ever been built on it. So it's actually kind of a forest area between our two homes. And so that's something that we've been thinking about. How big is it?
Yeah, how big is it?
Boy, I'm not
like
good.
Acreage.
I'm not good on
it a building lot, like you'd put a house there?
You could put a house on there, yes, definitely.
I don't know what size lot you have out there, if it's like if it's a subdivision or if it's
kind of a normal suburban, 1994 era.
You got an acre, 3 acres, a tenth of an acre.
It is pretty small.
You know,
we don't have much of a backyard, so we have the house, a ranch house, and kind of a small front yard, and then a pretty small backyard. So not a very large part of.
And this is a comparable size.
Piece of parcel of land, and so we've been thinking about that. And the folks who own it live out of state. So I guess they moved sometime in the past few years, and I believe they were the previous owners of the house that's on the other side.
Okay.
So Kathy was kind of interested in looking at it to possibly buy it, not to do anything with it necessarily. Right. She likes the forest area being there. And so that was one of the things we were looking at.
Yeah, so it could be a defensive move.
Yes. Because to have somebody come in and build a house there, Kathy wouldn't be too thrilled.
It's unlikely you're going to get hurt on it, meaning it's not going to, go down in value, as long as you're not overpaying for it today. So, obviously somebody that's going to look at it to buy it, to build a home, could justify paying more money for it than you could if your plan was to buy it and hold it as just because we don't want to have a neighbor that close on that side or something, we like the trees or whatever. But people have bought property for lesser reasons than that.
That's true.
So, but now, you can, depending on what they want for. Obviously, it always, comes down to price is a big determinant of that. But as long as, it's probably not, you're probably not going to get hurt on it, as long as you're not overextending yourself also. So, so
that was something that we were looking at over the past week.
So it's interesting. What county are you in out?
Franklin.
Franklin County? Okay.
Yes.
All right. So a little bit of news from this past week. Actually last week, HUD published their updated figures for 2023 regarding area median incomes. Okay, so that's AMI for short. When I refer to AMI for the rest of this show, that's what I'm talking about. So we're going to talk about those and obviously why they matter. And then we're also going to talk again about why it matters who you choose for your mortgage and your financing and why that matters. Turns out that the two are related to each other. So, but let's take a step back and let's bring this back into how things happen in real life. Okay. So let's say you're out looking for a house, or you're thinking that you want to buy a house, or you're thinking maybe we should move or whatever. And so you're getting to the point where you're either looking or going to start looking, or you're talking with real estate agents because for you, that's where the process has started. And they say, hey, you need a pre-approval letter. And so your focus is on getting that letter. And so you start to call around. Maybe the real estate agent gives you a referral. Maybe you know a guy or two. Maybe you have a neighbor. Maybe you have a family member or whatever. And so you start to call around and ask some questions, get some rates maybe. Honestly, at this point in the game, whatever they tell you isn't going to matter a whole lot because you're not at the point of locking in, or you shouldn't be at the point of locking in. And that's really the point at which whomever it is that's giving you the rate quote is committed, right? And so when I talk about, I spend a lot of time talking about playing above board, transparency, being honest, because obviously all of those things matter, but there are certain, I guess, if you really know what you're doing, if I wanted to be devious, for example, I could, when you talk to me, I could, and I know you're shopping around, right? Because you're not at the point, you don't have a house, you're not asking for a loan application technically or anything like that. And you ask me what my rates are. I can tell you anything. You're not going to be able to verify it. I don't really have to stand behind it and so forth because I'm not giving you a loan estimate at this point. I mean, even if I did give you a loan estimate, like if you asked for a loan estimate, and so then I guess I'm required to give you one, it wouldn't be a locked in loan estimate. And the figures that I quote on that loan estimate after 14 days, I wouldn't have to stick to them, right? And it's unlikely that at that point you're going to run out, find a house, need to do all this, through the thing, and within 14 days, especially in today's market. And so point is, I could tell you anything, and there are loan officers out there that will do that. Okay. So, you probably will just go with your realtor's recommendation. It's easier that way. Nobody really wants to shop. Nobody wants to make all those calls, those uncomfortable calls, the things that you're not used to making. You don't really, you might know what questions you want to ask, but again, I just told you that you're not going to be able to determine if I'm really being above board or not. Okay. All you're going to know is what I said compared to however many other calls that you make. Statistically speaking, most people don't make more than one. A small but measurable group make two. Almost nobody makes three, right? So we don't even get to the, get three and take the one in the middle. Kind of, those kind of strategies, that people will use in other, in other industries, other areas.
Throw out the high and the low and go with the middle.
Yeah, exactly. Right. Because, and see, that wouldn't even work here anyway, because you don't have a way to know if you're really getting apples to apples compared. Right. And most companies will play the game where they're trying to make it very difficult to make an apples to apples comparison. I know that because I will price shop, secret shop the market myself. And see, I know all this stuff. I know the questions to ask. I know where the levers are, the moving parts, what matters, what doesn't. And it's not always easy to make that apples to apples comparison. So when we get into this here in just a minute, I'm actually going to run through a little mini rate sheet. Okay. It's based on some figures I pulled earlier in the week. So it's real, but it's outdated at this point, because it's Sunday and there are no, technically you can lock in, but markets are closed. And, it's probably not a great idea to lock in on a Sunday anyway, because most lenders, if they're aggressively priced to begin with, hedge themselves for the 2 days, Saturday and Sunday, that the markets are closed, just in case one of these UFOs actually does land. And we can't actually verify, like you could go up and touch it, right? And so all holy breaks loose, and who knows what would happen in that case, or Trump were to get indicted. Oh, that already happened. Okay, so you see where I'm going with this, right? There is risk out there that aggressively priced lenders don't have baked into their everyday rate, right? So when I'm out quoting rates, I'm quoting the thinnest, the leanest, the most efficient, the best of the best, and ones that have no fat in there. When you do that, I can kind of tell that I'm with the right people because small market moves result in rate sheet reprices for them multiple times during the day. So I know, like, if the market made a move to the downside, right? So the market just said rates are going to get worse, okay? There is a lag effect with how quickly a lender will be forced to reprice themselves based on a number of factors way beyond the scope of what we're talking about here today. But part of that factor is how much, I guess, fat they have built into it, right? So every lender has a profit margin built in there. The thinner that is, the quicker that gets eaten up on market moves, so they have to reprice faster. So the lenders that I deal with, because I'm a broker, so I have a dozen or so that I have contracts with that I regularly work with. So I monitor them. I monitor them along with the whole market, so I know how they're doing in relationship to the market. I know how the market is doing as a whole. Not only because I'm watching bond prices, but I'm also watching lender reprices and all that along the way. So in this big chaotic kind of amorphous jungle of figures and charts and information and news and all these things, at the end of the day, somebody comes in and like, hey, I want to buy a house. What's my rate? Not because they're sitting there with a spreadsheet and they're taking it down, but what they really want to know is, what's my payment going to be? And for the most part, they don't mean like, okay, get me down to the 100% of a thing so I know like exactly. I just, like, we meet 7 or 8. Like I heard they're at 7. Are they up to 8 now? Did they go down to 6 yet? I'm like, well, those are Herculean like movements. They don't move like that. I will talk a lot about markets move. Oh, they went to the downsides. We're going to be worse off today. But when I tell you, like, when I work that back out in the form of, well, here's your rate now, or here's your cost. See, it's because it's got to be cost in combination with the rate. Otherwise, both of them are meaningless. It doesn't feel or look hardly like a movement, right? Because I'm way more sensitive to the movements than what most people are. So, but when you go and you start to call around, and what are large changes don't seem very large because they don't affect payment very much, you get confusion, right? So part of that is multiple rates, multiple options is difficult to compare, both because just the complexity of the industry itself, but also because of lender doing this on purpose. All right. So let's talk just a minute about revisit for a moment, because we've talked about it on shows before, how rates work, mortgage prices work, things like that. So on any given day, at any given time, there is a rate. Okay. Well, there's no one rate. There's a rate associated with a price. So there's a range of rates. Each rate has a corresponding price to it. All right. So when I say price, you think points. Okay. That's what points are. So points are the price or the cost for that particular rate. So when you say what's your rate today, well, I mean, technically, if I'm being a nerd about it, what rate do you want? And some loan officers, well, that's going to be my strategy. When they call and they want to know what rates are, I'm going to respond with, well, what rate do you want? Because I could get you any rate that you want almost, because there's a rate, and it's like the 3-card Monte thing, it's like, I'm going to, throw confusion at them so that it frustrates them, and then they'll just
go with whatever you say.
Yeah. Like stop. And they'll let me just kind of take control. Right. You can do that. It works. I've seen it work before. Incredibly taxing on the salesperson, though, or the loan officer. It's also taxing on the caller or the buyer. A confused buyer is not a buyer that's going to work with you or close, right? They're confused. They can't make a decision. They move on. Okay. So, but each rate, it's a range of rates. On the day that I looked at this, it ranged anywhere from 5% even all the way up to 8%. That's a massive range. What it takes to get that 5 is incredibly expensive. In fact, it's probably more points than you would be allowed to pay. Okay. At the same time, it's you don't get a whole lot of credit for that 8% rate. Okay. So, and what it does to the payment, when you're looking at what you're getting in return, as you get to those extremes, it just doesn't make financial sense. So when you hear me talk about efficiency, when you hear me talk about, in a minute here, we're going to talk about the sweet spot. That's what I'm looking for, that most efficient or best efficient, that's within the realm of possibility for that optimal rate and price. So what rate am I going to get? How much am I going to pay for it? What that combination would be. So, as I said, this is where it gets hairy. So, and I also said I was going to give you a mini rate sheet. So, why don't we do this? Let's go to break, and when we come back, I will go through what those numbers are, and then we'll talk about the implications, and then how and why you work through this and all of that.
That sounds good. You're listening to HomeWise. That's Michael Midget. I'm Stal Ponticus, and we will return right after this quick break. Welcome back to HomeWise. I'm Stal Ponticus with the host and creator of the show, Michael Midget. Michael, continue your conversation.
All right, Stel, thanks. If you're just joining us, we are talking about, we're talking about lots of things. We were talking about Stel's going to buy this lot next to him, so now we're committing him to that.
Yes.
So his wife can thank me later, so she gets to keep her trees, which that's important. The aesthetics, I throw a lot of numbers at things, always breaking it down to figures and spreadsheets and that. And I know that's not how the average, normal, everyday person looks at things. They look at it as far as, can I do this? Is it going to work? Is it going to hurt me? What they're really focused on is the feeling, right? The feeling, owning your own house. What does it look like? How does it feel? They're raising the family there. It's where it's home base. It's the nest. It's all of those things. When you look out your kitchen window, when you walk around the side of your house, what you see is important. So some people like you get to look at nature,
Mm-hmm.
and then what amounts to an empty building lot with some trees in it. Some people look at trees in that, but she probably looks at that and hears the birds and sees the green grass and the seeing winter turn into spring and the trees bloom. I don't know what kind of trees are there, but maybe at Christmas time you decorate if they're evergreen. I don't know, but point is that there's more to it than just the numbers. Let me look at the numbers. I'll work the numbers out for you. I will assume, through questioning and getting to know you, getting to know your scenario, your situation. That's why I ask so many questions. I will get a feel for what is important to you, what's not. And then I will man, the co-pilot seat and watch the figures so that if you want, you can focus on the fun stuff. You know what I mean? So, but that, that's all important too. But at some point we do have to pay attention to the figures. And I know that if you look at, digital searches and inquiries online, just empirically over the years from talking to so many borrowers, taking calls and that, what everyone wants to know is they want to know about interest rates. So we're going to talk about how interest rates work, including earlier this week when I made a little mini rate sheet. So if somebody would, if you called me up and just said, I just want to know what your rates are. Okay. I'm going to quote you some example rates here. They're not available anymore, but they were available this week. What I can tell you is that no matter what day you come to me, whether it's early in the day or late in the day, earlier in the week, late in the week, if it's early in your process or late in your process, you get the same mentality quoting this, meaning if I'm competitive today, I'm going to be competitive tomorrow. I'm going to be competitive at the beginning. I'm going to be competitive at the end. I'm not going to lowball you up front. And then, once I got you in and you really, I got you on the hook good, and it would be extremely painful for you to shift and get away. Then all of a sudden I'm going to decide to not be competitive. Okay. Don't do that. It's ignorant. It's rude. It's messing with people's minds. Don't do that. All right. I certainly don't do that. People need to have confidence in this process. Yeah, trees are pretty, grass is green, the houses are beautiful and that, but you can ruin those experiences if when you wake up every day, you look at it and you're like, you think of me because I did something that was underhanded to you, right? So I don't want to be that guy, but don't let yourself become the victim of that person. Okay. And then, and that's important. So, but let's get to it here. All right. So if you call me up, you ask me what my rate is, right? I could quote, what rate do you want? What rate do you want to hear? It's not the answer. That's really not the question you're asking me. I know from experience what you are asking me, which is, what's my rate with no points? All right. So on this particular day, I would quote you 6.875%, 6 7/8%. If I'm playing fair, I'm also going to have to quote you an APR at that same time. That'd be 6.917% APR. APR, annual percentage rate, that's your interest rate reflected in context of what the rate is with the associated costs that fall under the prepaid interest umbrella. None of this means anything to you. It's intended to be a figure to help equate one loan quote to another loan quote, but it has limitations. And if I know what I'm doing, I can play to those limitations to either minimize or maximize what that number is based on what I think might serve my needs best. So, for example, if you come to me, you asked me what my rate was, but you didn't say what your loan amount was. Okay. Well, exact same down payment, exact same FICO score, exact same loan. Everything is exactly the same in every respect, except if your loan amount is $100,000 or if your loan amount is $700,000, same note rate, different APR. Okay. Well, why is that? Well, because there are costs on there that are fixed that play into that APR. So they're the same on a $100,000 loan as they would be on a $700,000 loan. And so on the $100,000 loan, there's going to be a larger APR spread between your note rate and your APR than it would be at the 700. So what lenders will do is they will go and first off, they'll publish their rate. It looks like a good low rate. If you read the fine print, you'll see that you got to have a 40% down payment for that, pay 3 points, and it's on a loan amount of $726,000, blah, 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 right? So basically, you'd have to be buying a $1.5 million house. Right. So in St. Louis, if you're trying to buy a $1.5 million house, okay, then you could get that rate. If you're familiar with this market, then you probably know that there are some of those, but there's not a lot of those. And it would certainly be out of the realm of what would be considered average, typical, or normal for the area. Right. So there's not a whole lot of those transactions going on. More than you might think there are. Okay. But it's not the norm. Right around here, I think last figure I saw for St. Charles County, right at 400,000, which is incredible because not too many years ago it was 300 and something, like lower 300. So we're getting good appreciation. But when you get to be my age and you start thinking about what homes are, what does a nice home cost, for 400,000. I could get a really, really nice home, right? Well, I mean, you can get a nice home for that today, but 400 doesn't buy you what it would have bought you 10, 15, 20 years ago. Why? It's called inflation. There's that word again. So not only does it drive rates up, it drives prices of everything up, including real estate. So real estate just bears the double brunt of that because you have the higher prices and the increases in interest rate and increases in insurance and taxes and maintenance and all the other upkeep around that. So that's why it becomes one of your most costly assets, one of your biggest investments. And also the reason why it's so important to pay attention to all of these things, to do what you can to minimize what those costs are moving forward, because every dollar that you don't have to spend on that is a dollar you can keep in your pocket. Same house, not going to, how much you spend for it isn't going to affect the rate at which it appreciates, but it will affect how much equity that represents in your personal financial picture when you retire, and up to retirement and then past retirement. And if you believe the same thing I believe, which is family home is going to play a major role in a lot of people's ability to provide for themselves in retirement as an active retirement income vehicle, whether that's through a reverse mortgage or through some type of active investment or money producing and growing activity that's tied to the financing of the home, not just the owning of the property, meaning don't try and hurry up and pay it off as fast as you can so it can just sit there and we can live in it and can do what houses have done forever. But you're going to need to take advantage of the special types of financing. I mean, a 30-year fixed rate mortgage is a very special kind of loan. Just ask Warren Buffett. He believes it's the best investment for middle-class family, right? Buy a home, finance it with a 30-year fixed mortgage. You know what your costs are going to be moving forward. It's almost guaranteed over the long haul to go up in value. You're almost guaranteed to make money for it, especially compared to the alternative, which is rent, because you have to live somewhere, right? So anyway, getting back to the rate quoting thing, come to me, 0 is 6.875, okay? And that's what people want to know. But if you're willing to pay a point, I can get you all the way down to 6.25, okay? And if you're willing to pay 2 points, I can get you down to 5.875. So for 2 points, you can get into the fives. Now, a lot of people have been thinking, oh, when we hit the fives, I'll be able to refinance. I can refinance that buy down out of there, you know? And so when other people are talking about needing to do temporary buy downs to get to where they need to be to make it affordable, and then play the race game where, no, not that one, the one that you hear on every other station, on every other show and every other thing, but the race against time, or I need to refinance before this buy down runs out because my payment's getting ready to go up. When the other guys are playing the temporary game for about the same amount of money, I'm playing a permanent game. And there's no time clock on that. There's no ticker. You won't need to refinance as soon with me as you would with them. And you're getting that initial benefit from day one instead of having to wait and have that stress and all of that. Okay, so for 2 points, you get down and you can get down into the fives. Now, but Mike, who wants to pay 2 points? Well, guess what? Some lenders, when you go to them, are not priced as competitively because they're not as efficient, because they're larger, because they have branch networks and middle management and whole lots of that thing called overhead. Remember, so last week we were talking about self-employed. What's that bad word when you're in business for yourself called overhead? Well, they have lots of overhead. So because of the way, I didn't go backwards the other direction on this, is if you wanted to get a credit from me and go and like get a point credited to you, so like to pay for some of your closing costs, you'd go from 6.875 up to 7.375. Okay. Now that's a big jump going backwards like that. It's a big jump going backwards from 6.25 to 6.875. See, all of these are fairly big jumps because of where I'm at in the yield curve. And I promise I wasn't going to say a word, but it slipped out, so I'm sorry. That won't happen again. But yeah, there is a bond yield curve, right? And then you can put it on a chart and you can look at, okay, rate, price here, rate, price here, rate, price here, and you can look at the shape of that. And by looking at that visually, it's a lot easier to see than me talking through all of this. But you'll be able to see where that sweet spot is. So with me, you can reach that sweet spot with 1 point, but with them, pretty much the next best, national, like well-known big option, it's going to be 2 national banks, Wells and Bank of America. Okay. They're the closest, but they're not close. Okay. I'm at least a point better than both of those. All right. So if you were looking at, and it's really hard, it's really hard to go out and find an option where they aren't quoting points because that rate looks so bad. I used to do it. Now, as far as 0 point rates go, it's very competitive. But when I was, because before I was scouring everything and trying to figure out, like, why are people saying my rates sound high? Why are people saying my rates sound high? Well, so I had to go look a few times. And it is a little bit higher. Well, why would you go with me over him? Right, because you should, once you figured everything else out, it's drill down on rate. Well, see, look, read right here by the fine print. How much are you putting down? Well, we want to put down. We're going to put down 20%. We don't have PMI. None of that nonsense. Like, I know, but see this right here. This is 40% down. That's 220s, right? 220s. And see this thing right here, 2.625% origination. Okay, they called it an origination fee on there. I know that's code for points, right? It's a fee that you're going to have to pay to get that rate. Well, if you put 40 down with me, and then you want to do that same pricing combination, then here's my rate, right? And we might be like an entire percent lower on that. It's like the difference is just like insane. And, but when I'm able to have that conversation, I'm able to sit down and show somebody that, it's easy to see. But how many times do I not get that chance? Because we never got to the point where we were having that conversation because I got excluded from the conversation prior to that. So I've gone to quoting more aggressive, but still doable options. And then in the context of that, kind of giving like, okay, here's where you'd be if we were, if we were going to do, pay for your closing costs, right? So you'd have a no closing cost option. And here's your 0 point, which is like neutral. You're not getting anything for it, but you're not giving up anything for it. And that's where we end up. And then if you let me do the work to spreadsheets and do the calculations and the figures and that, this combination right here is the best financial choice to make. If your goal is to just most efficient borrowing combination right here. And right now with the way rates are, with the way that yield curve looks, it's right at 1 point. Okay. So my goal was to, most people don't want to pay a point. Some people don't have the option to pay a point, but the thinner I can make my margins, the lower I can make my compensation, the more aggressive and that I can massage this thing. I can pull money from other places, right? So let's go get a title company that has that same mentality to it. And let's go and build a process that is conducive to this to get you closer and closer and closer to that optimal combination without you having to go in your pocket and get it out. And because it doesn't work very well in this market at all, without you having to go to the seller and ask for it. Okay? Well, technically, by definition, this is all, I'm talking about a permanent buy down. Okay? So don't get lost in that comparison when I say temporary. It's not bad or good. It is what it is. But I prefer this version of it. Yeah, I prefer a different version of it for all the reasons that I've said. But I'm also building that option because we're trying to get there without pulling additional money out of your pocket. Because given, when you're looking at all of your situations, you're comparing one to another. If I'm cheaper in these other ways, then that's money you would have spent. It's found money, it's free money. We can put it to a better use and not only, like just build a better, more efficient transaction for you. So we will, let's go to break and we'll continue with the next interesting piece of this, which is the EMI piece.
Okay. You're listening to HomeWise. It's Michael Midget. I'm Stal Ponticus. Glad that you're along for the show this week. And we will return in a moment. Welcome back to HomeWise. I'm Stal Ponticus with the host and creator of the show, Michael Midget. Michael, continue your conversation.
Thanks, Stal. So if you're just joining us, we just had a really heavy segment, heavy on figures. I know figures are difficult to do. They're difficult to do face-to-face anytime, right? But even more, even harder on the radio, right? Because this is just audio. Even if you're watching us on Facebook, YouTube, Rumble, I don't have visual aids here, right? So what you can do is, if you're listening to us on the podcast, there's this pause button. You can rewind, you can go back, you can listen to it. If you're catching us in the car, just find us online, HomeWiseRadio.com, GoShelter.com for the mortgage website. You can call or text me, 314-275-0314. I'll answer any question for you. In addition to, I started to give you a rate sheet. If I'm playing above board, full transparency, there are some additional information you need to go along with that to be able to do that. I did give the APRs, but there's still some more additional information. But because we're in an audio format, I can give you an 800 number to call if you want to get the rest of that. I can tell you above board, there's no funny business going on. You don't have to have three arms, call me on a Tuesday afternoon and when the moon, like none of that crazy stuff. It's just, it's straightforward. It's transparent. If I say no points, it's like literally like no points. I didn't rename anything to call it something else. We don't charge processing fees. We don't charge origination. I mean, it's just flat, straightforward, okay? But that toll-free number, if you need more, it's the same one you hear at the end of every show, 888-497-2558. It gets you to the same spot. You might have to hit a couple other buttons to get through to me, but it gets you into my company there, all right? So we went through what that rate sheet was, 6.875 and 0, 6.25 and 1 point. If you want to get a 1 point credit, you'd have to take the rate up to 7.375. These are live rates earlier in the week. They're not live now. There's a new set of them, but if the market moved like a certain proportion wise, then these would be that same proportion higher. They're not going to go up because, oh, well, now I got a real one here, or they're great today, but they're not great at the end of the process. But the market is the same. Sometimes the market will move between the time we initially quote and then when we get into it. By the way, if that happens and I'm not able to deliver, like if I quote on day one and now 23 days later, I don't hear anything from you, all of a sudden you show up and you want to know what rates are, like, well, I give you the quote, oh, these are different. Well, here's 23 days of market movement. Here's the proof that it's, because I have all these margins programmed in, spread, use technology. We're fast, we're simple, we're straightforward, we're transparent. You're going to hear everything. If you think I explain a lot here, it just gets, not worse in a bad way, but if you like to be educated, if you like to have confidence in your decisions, then you will like dealing with me. If you don't, you can try telling me, Mike, I don't want to hear any of that. I'll do my best to not educate you and try to keep you informed. But I will be honest with you, I do kind of have a problem with that, right? So if you're the kind of person that just can't tune me out, if I start to go too far, then, we might not be a good fit. By the way, I haven't met that person yet, but I have to imagine that they're out there somewhere because, we're getting ready to see little green men walking around here. I keep, that's just it's a fascinating story. It's been around forever, but it seems to be getting more real. But we're also getting closer to a presidential cycle. So you kind of have to wonder, like, is this a misdirect? Is it, it's just.
You know what I find fascinating, and we're going into I don't want to go into a rabbit trail here on you, but since you're going to say UFOs really quickly, crop circles, speaking of property, crop circles are fascinating to me because there are no exits or entrances. So it's obviously something from the air that's causing it. And what is creating the crop circle?
Or underneath.
Or underneath, maybe. But the fact that,
what makes crop circles? Roundup.
Roundup. Yes.
Roundup would cause crop circles.
That could be.
That's just devil's advocate, right? Okay.
But the fact that the corn is bent and not broken, and in some crop circles they're weaved together. There's a whole aspect there that fascinates me too, and I wonder, what? There's something extraterrestrial going on here.
You sound like you know a thing or two about that.
They just show up out of nowhere.
We could do a whole show on it.
We could.
I mean, you could do a whole podcast, like a whole thing. It could be a whole channel.
Yes, definitely.
There are whole channels about that.
Oh yeah,
We're not coming
so to get back on track, I'm sorry, I didn't mean to
no problem
distract you.
So we were talking about rates and endpoints and that, and one of the things earlier last week, HUD came out with new area median income things. So Fannie and Freddie have affordable lending, affordable housing programs. If you make less than a certain percentage of your areas, and it goes by county, make less than a certain percentage of your area's AMI, area median income, then you qualify for one of, Fannie has their version, it's called Home Ready. Freddie has their version called Home Possible. You would qualify to buy under one of those two programs if you make less than 80% of the 80% of the AMI. And around here, let's just call that 80% is about 80,000. 100% of AMI, or the average of the AMI that HUD's determined for this area. St. Louis County, St. Charles County, Franklin County. I'm not sure, it might be a little different.
Jefferson?
I'm pretty sure. You know what? I haven't looked at those recently, so I haven't looked at them since last week. I just wanted to get the new numbers because they go up a little bit every year, and so they're up to 80,000 and 100,000 this year, and there are other percentage available for other things because HUD uses this for a lot of things, but for what we're going to talk about here in just a minute, those are the two thresholds that are going to be important. Okay, so just real quick, so now think back a few weeks ago when we were talking about the story where Fannie and Freddie revamped their matrix of loan level pricing adjustments, right? Just real quick, those are the adjustments that occur on a loan-by-loan basis when the loan's delivered to the agency for purchase from your funding lender. Primarily, that's where the risk-based pricing takes place. FICO score and down payment. There are other factors, but those are the two big ones that are worth focusing on here. How much is added to the rate? It's actually a price, but it equates to rate because people can only pay so much. What that rate add-on ends up being when that loan is delivered. Okay, so the rates I gave you earlier were not the affordable housing rates. Those were just, hey, I make a bunch of money, or I'm buying an average ordinary house. By the way, you can buy an average ordinary house with these programs, but you just have to make less than but those rates I quoted you were for, let's say you make $120,000, okay? And you're buying a $400,000 house, you're going to put down $20,000, so it's a $320,000 loan. See, now we're starting to get into some of that extra information you would get in the fine print if you were to call it, some of it, but not all of it. Those are the rates that I would quote you, okay? Now, I didn't go see what I would quote you once we get into conversation, because you probably wouldn't call up and say, hey, I make less than X number % of the AMI. I want to do that affordable housing program from Fannie Mae or Freddie Mac, and it's called this. I mean, I guess I could get that call, but I would have to ask, where, like you've talked to somebody else before, haven't you? Tell me what happened. Why didn't they want to do, like, okay, anyway. See, we try to make this funny and light and uplifting, even though it's such a heavy, like,
because if somebody came to you,
subject,
yeah, with all that lingo, it'd be like me walking up to you with all that lingo, and you would think, who'd you talk to before you came to me? So I understand that totally.
Well, you know what? And sometimes, see, that is, if I'm doing my job, that is some of what I need to do, because if you've talked to, let's say you've talked to 6 other lenders and none of them would do your loan. You think that's something that I would want to know. Okay. Well, they could have just all been idiots or not known what they were doing or asked the wrong questions, or maybe for whatever reason they weren't a good fit, or, or whatever. Or maybe not even all of them turned you down, but you just turned some of them down because there was something not a good fit there. In addition to all the other, like, the technical, like, legal things that I have to do, if I'm going to work well for you and with you, I would need to know what happened there, just to see, maybe we can make this a short conversation. Maybe we need to make this conversation about something that it would, other than what it would normally be, because there's an issue. Maybe it's a loan or lending issue. Maybe it's a person issue. Maybe, who knows what it is, but it's worth having a conversation about or talking about. Right. So, but yeah, they don't call up and ask all of those things. It's my job to look at this and see, oh, you know what? You make $79,500, or let's say, we get to the point where I'm getting the initial information and he says he makes 80. Like, oh, okay, you're right on the cusp there. Okay. So, well, do you make 80 or do you make 79.5? Do you make 81.1? See, because it matters. So that number I gave you, 80,000, is really not 80,000. It's $80,640. If you make $80,641, no bueno, no good. You don't qualify for that. If you make $80,639, $2 difference. What's that equate to over the course of a year? Like 6 cents a day? Maybe probably not even that, like less than a penny a day or something like that. It makes a difference. Here's why. Because if I can fit you into Home Ready or Home Possible, I get to make those loan level pricing adjustments go away. Remember those things that get added onto the loan when the loan gets delivered to Fannie Mae and Freddie Mac, that's based on your credit and your income? I'm sorry, your credit and your down payment. Threshold based on income, right? But that was the qualifier that we used to get to this point. If I can fit you into that, I can make the loan level pricing adjustments go away. Well, depending on where you fit in that matrix, how much was being added into that loan rate that you would have been quoted had you not fit into that affordable program, for purpose. I mean, it could be anything. It could be as little as 0. So if you're putting down 40% and it's that across the board, then you'd have no loan level pricing adjustment and it wouldn't benefit you at all. But those programs aren't designed for people putting down 40%. They're designed for people to put down 3 to 5%. Well, now, see, so it used to be if you were putting down 3 to 5%, you had this big, massive loan level pricing adjustment. So Home Ready, well, okay, if we can fit you into this, we're not going to charge the lender for these extra add-ons when they deliver the loan. Okay, so remember, it's not Fannie Mae and Freddie Mac charging you directly; it's they charge the lender when they deliver the loan. So if I'm a lender and I can fit this into Home Ready or Home Possible, but let's say I don't write it up front as Home Ready or Home Possible, or let's say I don't tell you that I do. So so you didn't even know what those programs are, were you?
No, technically, no.
Right. I could tell by your facial. So I have the advantage of being able to watch your facial expression as I'm talking to you.
Not having dealt with Freddie Mac or Fannie Mae.
Right. So if I just never even brought those words up, but I could write the loan as Home Ready or Home Possible, get the discount from Fannie and Freddie when I deliver the loan, but who says I delivered you that same benefit through to the other side?
Mm-hmm.
See what I mean? You'd never know.
No.
Maybe the loan officer doesn't even know. So inexperienced loan officer doesn't see this, writes it up this way, but the underwriting manager does.
Mm-hmm.
He or she is, in tune with or working with the capital markets manager,
Mm-hmm.
right? Because if this is a lender that underwrites all this, keeps all this, in-house and does all those things, they have all this under one roof. So they would have the ability to do this. The reason I know this is a thing, because I watched it happen one time. One time. Furious. I walked. I walked away from because if you don't believe in where you work, who you work for, how in the world can you think that you're going to do well for your buyers, for your client, for your borrowers?
Mm-hmm.
This is their house. This is their biggest thing. So if I can fit you into Home Ready or whatever, let's say it works out to a point. Okay. So we already talked about what that point is worth. 6,875 versus 625 versus 5,875. You can get down to that 625 and not have to pay that 1 point if you're with me. But if you're with the other lender who's not as efficient, and maybe they're not even passing on all of that benefit to you, you might not end up so low there. But let's jump ahead a little bit, and let's say that look at the difference between on that loan I showed you, talking about $320,000. The difference between 6,875 and 6.25 is $132 a month.
Mm-hmm.
All right, that's big.
Sure is.
Loan decisions get made based on numbers much smaller than that. Okay. Now, people will move heaven and earth. Some people will make lots and lots of calls and negotiate and do all of that to save half that amount. What you really could do by just making a call to me in this case, but by paying attention and looking at all this. Okay. So that $132 a month, if you were going to, just say, I don't care about that. I'll just take the other thing because I can afford it. Well, if you take that $132 and you reinvest it back into the loan, you'll save yourself $120,000 over the term. On a $400,000 house, it's over 25% of the value. Or knock 5 years off your loan, right? People will do the biweekly thing to knock 7. You can knock 5 off, and without even prepaying anything beyond what you would have paid, right? So all of this benefit is coming from shopping for your settlement services, shopping for your lender, or going with the right lender and letting them shop the market for you. So when you come to me, if I put you into Home Ready or if I don't, either because I consciously didn't do that or because I didn't know any better, I don't benefit either way. I make the same amount. Good loan, bad loan, low credit, high credit, doesn't matter. I always end up in the same place. I'm indifferent. So the point is, just do yourself a favor, pay attention, and call. Let's have a conversation about it.
Yeah, definitely.
So HomeWiseRadio.com, as always, this episode, previous episodes, my mortgage website, GoShelter.com. You can find out how to get me there. Email, phone, or if you're driving around in the car right now, 314-275-0314. In just a couple minutes, I will be available
Awesome.
to talk.
Good.
Call or text on that.
Good. Awesome. And that wraps up our show for this week. Thank you for joining us for HomeWise. That's Michael Midget. I'm Stal Ponticus. It's been a pleasure joining you, and we hope you'll join us again next week for another edition of HomeWise.
Loans and loan information provided by Shelter Mortgage, Inc. Visit us at GoShelter.com and MLS number 192609. A Missouri residential mortgage licensee and equal housing lender. Call 888-497-2558 for additional cost information. Other restrictions may apply.